Hi, Gabriel Josiah here again. Okay, right now we'll be continuing our discourse on Unit 7. And there are a lot of modules in Unit 7. I believe we're going to tighten our seatbelt to exhaust those modules and understand the subject of the Unit 7 in financial statement analysis, which has to do with ratios. We are looking at very graphically. Okay, so let me share my screen quickly and let's look very fast into this module very quickly. Okay, so the first module in Unit 7 talks about accounting types of accounting ratios. Accounting ratios are classified based on the way they are constructed and based on general characteristics. So accounting ratios are very essential for accountants because they express in numerical terms the mathematical calculations and the results help decision making. This is very critical. So ratios can be seen as classified in different types. We have coverage ratios, return ratios, turnover ratios, or component percentage ratios. And they are based on their calculations, how they are calculated, the way we classify them in accounting. Now, for the coverage ratio, it shows the ability of the company to meet its obligations, how it's able to cover its expenses or its obligations by what it has generated. So economic benefits are generated and they are used to offset expenses. It's very simple. So, for example, we have the interest coverage ratio that shows how many times interest on fixed capital, which is debt of the company, is covered by the company's operating profit. So the operating profit is the cover while the debt is the bottom. So on top is the operating profit while the bottom we're trying to offset the liability or the debt. So that's what coverage ratio is in very simple and absolute terms. So the return ratio is expressed by the benefit accruing to the company arising from a resource committed. So we've committed resources, so we're trying to see the returns it generates for us. It's a relationship between the benefits obtained and the resource employed. So you've injected resources into the company in form of assets and other economic benefits. So the return is what you get back. Very simply. So an example of a return on investment which shows the level of profit earned by a capital invested over a period of time. So I invested 100 million naira in form of buying machinery, assets. So the amount invested could be expressed in terms of the revenue I generated with those assets that I bought. So after activities are on, economic activities are carried out in business for a period of 1 year, let's say, how much am I able to generate based on what I've invested? It's what is called return on investment ratio. So the turnover ratio shows how many times the company has been able to make use of its particular resource to generate benefit to the company. So the revenue, for example, is the resource, or let's say the non-current asset you used for economic activities is the resource you are using to cover, to check how many times you're able to generate a particular amount of benefit. So the turnover ratio also expresses absolute terms or mathematically how we understand the company's ability to generate resource or benefits. So this figure is absolutely expressed in terms, in times. We'll look at an example and buttress this very clearly. So the example, for example, is we're looking at is inventory turnover ratio. It measures how many times the company has been able to use the amount committed to inventory, which is formerly known as stock, or we still call it stock, to generate sales, which is revenue, during a particular period. So we also have component percentage, which measures the relationship between the various components of an item, the item in percentage terms. So an example is gross profit to sales or gross profit to revenue, and total expenses, which is total overheads to sales, fixed or variable. So component percentage help us also understand accounting ratios in absolute terms. Now, there are 5 groups of ratios that can be calculated from the income statement, the statement of financial position of a company. So ratios principally are drawn out from those 2 financial statements, the income statement and the balance sheet. So these groups of ratios measure the operating performance and the financial condition of a company. So we have 5 of them, and we'll look at them one by one. Number 1, we have the profitability ratios. These ratios are used to assess the profitability of the company and the level with which the business has generated revenue to offset the capital employed. So the business is there for profit. You've injected or invested funds to get returns. So profitability ratios express this in absolute terms. This is very important. Talk about liquidity ratios, which is number 2, and they measure the ability of a business to meet short-term obligations. That is, you should pay your day-to-day debts when they fall due by using assets that are quickly converted to cash. Exactly what liquidity ratios is all about. So your inventory, your receivables, your prepayments, your cash are supposed to help you run the business effectively if managed well. So those are your liquid assets. We call them current assets, and liquidity ratios could be calculated in these terms against your liabilities to see how you are running the company and your ability to meet short-term obligations. This is very important. These assets are normally referred to as liquid assets, and they are shown in the statement of financial position as current asset, like I stated earlier. They are also referred to as circulating or working capital. So how you work on your day-to-day activities is what the current asset generates in form of capital for you. The ability of the company to utilize its long-term resources in its day-to-day operation depend on the adequacy of working capital. So you need to work now to predict the future, to buy the future. So it's very important to manage your day-to-day, which will lead to your long-term solvency. So a company that it's a going concern must concentrate on improving and the efficiency or effectiveness of its working capital operations. This has to be adequate and very important for every company that is of worth and must survive in the long run. The difference between these current assets and the company's short-term obligations, which are the current liabilities, is what we call working capital. So your CA, which is current assets, and your CL, which is current liabilities, have to be in sync. Sync in the sense that the current assets must be above the current liabilities at all times. So there's an industry average that is always recommended by experts. Most of the time, it's recommended that your current assets should be twice your current liabilities to stay afloat in any business. So the difference between your current assets and your current liabilities is what is called working capital. We look at another type of accounting ratio, which is efficiency or activity ratio. It's called efficiency, or you could also call it activity ratios. They are ratios that measure how efficient the business has been utilizing its assets. So you have assets and they could be underutilized. So these ratios express and to see if you've by percentage or by percentage explanation, how you're able to generate returns with these assets you bought. So a lot of businesses invest in assets, but those assets most of the time generate less returns, and they are underutilized. So these ratios help us express the efficiency and the activity you employ these assets to bring in returns for you. Very expressly. Another set of ratios is long-term solvency or leverage ratios. These ratios show the capital structure of the business, whether the business is in generating funds with its equity, which are internal fund generation generating system, or externally funded businesses. So the business could be funded externally, and the long-term solvency or leverage ratios speaks to this very express. So the capital structure of the business depends on these long-term solvency ratios. So they also show the mixture of the business capital between equity, which is your proprietary capital, and debt, which are your long-term liabilities. So equity capital is generated from shareholders internal, while debt capital is generated from outsiders, which are external shareholders. So the mixture of the two and balancing them is essential to be able to calculate these ratios and provide advice very, very constructively. They also provide information on the degree of a company's fixed financial obligations, the ability to satisfy these financial obligations. So you have obligations to internal fund generators and external fund generators, which balances your capital structure. We also have the fifth one, the final one, which are investment ratios. The interest of investors, potential investments, people that invest in the company. They show the level of returns that an investor can expect from investing in the business entity. They are referred to also as shareholders ratios. So investments are very important, and ratios geared towards calculating this in percentage or absolute terms will help express to stakeholders in very, very clear terms how their income or their investments are growing. Take note of that. It's also known as shareholders ratio. Okay, so these 5 sets of accounting ratios are excellently presented, and they help us understand the basics so that in every exam or every analysis, you'll be able to classify these ratios where they belong and how to analyze them based on these powerful headers. Thank you very much for this module. We'll see the next module, and let me know what you think about these types of accounting ratios and your observations. Make your comments in the comment section. I'll attend to them expressly. And don't forget to like, share, and consider subscribing so that when new videos are uploaded, you click the notification, the bell button, so that you'll be notified to get equipped and get more value from these classes. Thank you very much, and I'll see you in the next module. Bye for now.